Welcome back to On Main Street with Rick Amato. Investors under the age of 40 are possibly facing a special situation in that many of them have never seen or lived through a recession and may not have the quite perception of the realities of the market. Let's clarify that. Someone who's on top of this story very closely is certified financial planner, founder, and CEO of Forte Impact Advisors, Jeff Hammer. Jeff, welcome. Yeah, this is kind of interesting. What can you tell us about this?
Yeah, it's an interesting phenomenon we're seeing. Obviously, there's all these various indications that track everything from consumer confidence to volatility indexes and things like that. But one of the things we're finding that's fairly unique with a large portion of the population under 40 is since they haven't lived through the housing crisis that we saw in the mid 2000s, haven't necessarily seen a true recession in quite some time, or at least not since they were probably in middle school or high school. They didn't acutely feel that or see that whole aspect of, even in COVID, we had that 30-40% correction very quickly, but it was something that bounced back within a month or two. So nobody felt that extended pain that comes with a true recession that can, historically, they typically will run anywhere from a 13 to 39 month sort of window of time of saying the markets can be quite depressed. And that's what we're seeing there is without that, there can be sort of a bit of an unfounded optimism that the markets will always continue to go up, and no matter which market it is that they're looking at.
Yeah, that's very, very interesting. I hadn't thought of that, and it makes sense that the reality of someone of that age group doesn't quite match things, or perception, I should say, doesn't match reality. What would you say to someone, say, under 40, who says, "Yeah, but I've been told if you stay in the market long enough, every 10 years, you're going to find over a 10-year period, you're going to find a rise in value."
And it's a great point. And part of what we look at there is it really does come down to timing. And part of what we don't know, right, is what are the markets going to do and when. The reality is if we knew best, we'd all retire the day before the markets exploded and continue to have an explosion of growth throughout our retirement years. The challenge is, right, in many cases, especially if we do take a long-term view, you should expect there to be a positive return. If we look over any extended period of time, whether it's the stock market or other markets, you will see that they do tend to go up. But there are also these dry spells that happen. There's various ones that have run for a 17-year period of time, 11-year period of time. The one we saw most recently was in the 2000 to 2010 decade, where basically the S&P 500 was up 0.4%. So as a result, a lot of times folks may say, hey, there's growth, it may be explosive growth, but then there's stagnancy. And it really depends on when do we need to access funds. We hear that whether it's stock market, whether it's, the precious metals markets, real estate, we often hear frequently, real estate always goes up. That's not always true. Again, as we've seen in 2006, 7, 8, right? A lot of times folks may have lost a significant amount of their housing value, and it took them a decade to get back to even. And as always, location, that always factors in as well. Not all properties created equal. So we look at that and say every market has its point where it flips. How do we design that so we have shock absorbers?
Yeah, what you're saying, Jeff, makes total sense.